Hello, this is Jordan, and this is your precious metals video market update. This video is being recorded on the eve of Good Friday. It's late Thursday night, April 9th, 2020. And in this video, I'm going to provide a handful of charts and an update on the technicals of the sector, focusing on gold and gold stocks. Okay, so starting off here, we have weekly line charts. At the top, we have gold. At the bottom, we have gold against foreign currencies. At the bottom, that's a basket where it's equivalent to gold multiplied by the US dollar index. And that's significant because, as you can see in the chart, that chart actually tends to lead the gold price in US dollars. It bottomed at the very end, the tail end of 2013, well before gold did in US dollars. It made a new all time high recently in 2019. Of course, that's well before gold. But again, that's a good leading indicator. So, what we're seeing here is gold against the foreign currency basket. It's basically at a new all time high. If you look at gold, I believe now that it is against every major currency, it's at a new all-time high, except for the dollar and anything that's tied to the dollar. I believe it just made a new all-time high against the Swiss franc. So that relative strength, that implies that gold and U.S. dollars will follow suit, and it's obviously getting much closer. Gold closed the week surging above 1,700. It closed just below 1,753. You can't see the continuation inverse head and shoulders pattern, and that projects to roughly 1880 to 1950. It depends if you measure it using closing prices or just intraday prices. But there is some resistance around 1800. So there's more resistance around 1800 than 1900. So gold has obviously been on a tear recently, other than that sharp snapback. And so, again, there's a measured upside target to around 1900 to 1950. It could go there, or we could see a correction at 1800 because there is some resistance there. Now, let's talk about fundamentals. The major driving force for gold is real interest rates. It's basically inversely correlated to real interest rates. Another way of looking at that in a secondary fundamental driver is the yield curve, and that's easier to show here on a chart because the real interest rates, the data I like to look at tends to be lagging. But anyway, the yield curve can also be used to explain fundamentals, and we see the yield curve at the bottom. At the top, that's gold against the S&P 500, and the yield curve at the bottom, when that's steepening or rising, that is bullish for precious metals. And so what causes the yield curve to steepen is you essentially get, you have the long end of the curve. So longer term yields are rising much faster than the short end. Or you can have the short end going down or declining much faster than the long end. So you could either get rising inflation or inflation expectations, or aggressive Fed action, Fed rate cuts. So as we can see there, the yield curve, it's kind of been bottoming the last couple of years. I mean, it dipped below, it inverted slightly, but it's broken out now. And not by coincidence, we see that the gold against the S&P 500, that chart has also broken out. And it's broken above the weekly moving average there, which is equivalent to the 40-month moving average. You can see that that moving average has been really significant as far as showing the primary trend over time. So clear breakout there. And just another word on real interest rates and fundamentals. The policies that we're seeing, I mean, we're seeing it both on the monetary and fiscal side, and especially on the fiscal side. A lot of the money, the helicopter money that we're seeing, we're probably going to see more of that. That money is going to be more inflationary this round because money is going to go into the hands of people and consumers and households. Less so to corporations. It's still going to corporations. We're still seeing that. But in addition, we're also seeing helicopter drops, and we're probably going to see a lot more of that. So this time around, that policy is going to be more inflationary. Interest rates, I mean, the Fed is probably going to stay at zero for a long time. So that means real interest rates are going to decline, at least probably over the next couple of years. So in short, we have a really, really good fundamental setup here. It's stronger than what we've seen in the last several years, even though gold has done well. Now, a quick note on silver. Silver had the mother of all false breakdowns. Well, I mean, a couple of months ago, it had a false breakout. I was talking about the importance of 1850. It broke above it. Then that turned out to be a false breakout. Then later that month, it gets hit during the crisis, and it closed. It only closed below 14 for 1 week. If you look at the monthly chart, and this is the quarterly chart here. So on the monthly and quarterly chart, if you just look at a line chart of those, you don't see the crash. So this is why closing prices are important. You look at the quarterly chart here or the monthly chart, silver never closed below that support at 14. So it only did it on the weekly chart, it only did it once, so it popped back above it. So I mean, that is a bear trap and a false breakdown. And I'm showing the quarterly chart here, but I would look at the monthly chart. This month, if we get another close above 14, I think that's giving us more confirmation that the move below 14 was a false breakdown. So, I mean, for silver, there's some resistance at 16. The big resistance now is around 18 or 19. It really has to surpass that if it's going to get into a real bull market. But given where it is now, just around 16, where there's resistance, if it travels back to 18, 19, that's more room for silver stocks to obviously continue to recover. Now, here I'm showing at the top, I'm showing GDX against the S&P 500. At the bottom is GDX. And this is something I've been focusing on a lot since the beginning of the year. And that's how are the gold stocks performing against the stock market? Look at that chart at the top. Again, that's GDX against the S&P. You can see this relationship, gold stocks against the S&P, regardless of which index you use, it's made a massive double bottom. The first low, second half of 2015, and then you have the second low there, September 2018. So it's made this massive double bottom, but it hasn't quite broken out yet. It's still kind of been, I mean, if we're looking at this from a bird's eye view, it's still kind of in this bottoming formation. Look at those horizontal lines there that are just slightly above where the ratio is. And if you look at that going back to 2014, you can see that those are at significant levels. So if the ratio if it can surpass those red lines, then it's going to be trading at a 3+ year high. So, I mean, that would be very significant. In addition to that, I should also note, look at the 200 and 400-day moving averages. Those are long-term moving averages. They're both aligned properly. The 200 is above the 400. They're both sloping up, so that's bullish. So, I mean, I do think over the weeks and months ahead that we should continue to see gold stocks outperform the stock market. But this is really significant if we're to see, kind of a decoupling there where we, regardless of what the stock market does, we really want to see this chart, that ratio, break above the red line and continue to rise, because we haven't seen, the stock market has done really well until the last couple months. And, if the stock market, if it's struggling and gold stocks are outperforming, gold's doing really well, that's going to pull in more capital into the precious metal sector. And eventually that's going to trickle down to silver in the juniors, in the penny juniors, the exploration stocks. So that's why this chart is so important, looking to see gold stocks outperform the S&P 500. And by the way, if you look at the bottom there, just GDX by itself, that needs to be outperforming the S&P to have that big breakout, past that 7-year resistance. This is something that I talked about this week in a public interview and a premium update. In the last couple of days, this is something that I was going to be watching. The Dow Jones U.S. Gold Mining Index. I've tried to find info on this index. It has 25 companies in it, but I believe that Barrick and Newmont and Franco-Nevada are, I think it's a cap-weighted index. I mean, it has to be. I think those three stocks, especially Barrick and Newmont, are a huge percentage of this index. And I mean, this chart looks similar to Barrick and Newmont and Franco if it was just those three companies. And Agnico is in there, and there might be a couple others. But anyway, this is something that I was watching for. Could Barrick and Newmont in this index, could it make a new high? Could it surpass that high in the first quarter? And today, Thursday, this thing was up 13%. So, I mean, it passed the test today with flying colors. I mean, it just surged above that Q1 high. And this is significant because big institutional money and generalist money, it's going to go into gold, GLD first, and then secondly, the biggest gold stocks. So like the gold stocks that are in this index. So the fact that, I mean, we see gold has more than recovered from the crash. It's broken out, made a new high. Now we see the largest gold stocks doing that. I mean, that is real significant. This is really bullish for the sector. And then looking at the bottom there, you can see that's the index, the ratio chart, the index against the S&P 500. That's really close to having a major 7-year breakout, breaking above the 2016 and 2013 peak. So, I mean, I can't say enough how important this is and how great this is for the sector that the largest stocks have more than recovered. They've surpassed the Q1 peak, new 52-week high. Just very good for the entire sector. And that leaves us with the chart here, which I like to use in my updates, or in these videos, I should say. And focusing on GDX, I mean, that's recovered. It basically closed. We'll round up and say it closed at 29. The multi-year resistance is at 30 and 31. I would not be surprised if it reaches 30 or 31, and then it consolidates for a couple weeks or maybe even a couple months. I mean, we don't know what's going to happen. We can't predict the future. Obviously it had a crash. It's recovered almost 100% of that. I mean, it's getting very close, but there's huge resistance at 30 and 31. So I would not be surprised to see that resistance force some digestion of the rebound and some consolidation. GDXJ is still, it's obviously lagging a little bit, but I mean, it's recovered pretty well. Hasn't recovered quite as much as, Barrick and Newmont and the GDX companies. But let's see, that closed just below or just above 35.50. So we could round up and say 36. Resistance at around 41 or so, and then the big resistance at 50. I think when we see GDX breaking above the 2016 high there around 31, when we see that happen, that's going to help the rest of the sector. That's going to help more money go into the juniors and the exploration companies and the real small cap juniors, the real penny juniors. That side of the sector, I mean, when speculation there is really going to take off, that's going to happen when GDX and GDXJ take out those 2016 highs. We're obviously not there yet, but we're obviously getting closer. That's all for this video. Thank you for watching. I hope it was informative and educational for you. You can follow all my work at thedailygold.com. Consider subscribing to my premium service. It's only $149 for 6 months. Go to thedailygold.com/premium. And I mean, this crash in the sector has created a setup where we can actually go up the risk curve in juniors and get even better than normal returns. So it's really exciting. If you're not a subscriber, I hope you'll consider joining me. And again, thank you for listening to this video, and I look forward to publishing another one in the weeks ahead.